Well, good Monday morning. Welcome to Connect, the California MBA's weekly podcast featuring one-on-one interviews with movers and shakers in the mortgage industry. I'm Dustin Hobbs, Communications Director here at the California MBA. And although we're halfway through January, this is our first podcast of the year, so welcome to a new year. As you've noticed already, we've got a little bit of a different look and feel for the podcast this year. Still going to be doing our one-on-one interviews, but we've updated the look just a little bit, and we're actually are going to add some themes for this year. So each month we'll have a different theme that will play into the conversation we have with our guests. And at the end of each month, we're going to be having a sort of a mini panel with several guests on that topic, and we'll dive into it in a little bit more in depth. So this month we're going to be talking about origination, sales strategies for the year ahead. It seems like an appropriate topic here at the beginning of the year. And I'm really excited to get into the conversation with our guests here, and we'll do that in just 1 second. But before we do, I want to thank our sponsors over at Incelerate. So if you're looking to close more loans in 2021, definitely suggest you check out Incelerate. To experience Incelerate's award-winning customer engagement platform that features lead management, CRM, call routing, sales enablement, marketing automation, borrower engagement, and data intelligence through innovative use of multi-channel marketing, text, social media, email, direct mail, phone, ringless voicemail, retargeting, and much more. So Incelerate, bottom line, helps lenders close more loans through better borrower engagement. And to schedule your personal demo, go to incelerate.com. You can find out more there. All right, before we jump into the conversation here, I want to toss it over to Susan Milazzo, our CEO, for this week's weekly update. Susan?
Thank you, Dustin, and welcome everyone to 2021. My name is Susan Milazzo. I'm the CEO of the California MBA, and I'd like to welcome you to the first podcast of the new year. I want to start out our podcast by giving a big thank you to those companies who are President's Council sponsors in 2021. These companies are providing an extraordinary level of support for us, and it's an annual sponsorship that'll last throughout the year. They'll be featured at each of our conferences this year, as well as all of our marketing. The companies are providing an investment into the industry because they realize that by maintaining our strength, we are able to maintain our advocacy program, which of course is the cornerstone of the California MBA. So thank you to all of your companies who were President's Council sponsors for 2021. We greatly look forward to working with you this year. We have 2 free webinars to start out 2021, so you can join us later this month. First up is our Mortgage Technology and Marketing webinar, which will be on January 26th, People versus Automation, Creating Frictionless Transformation in 2021. We'll be featuring speakers Anthony Galliano and Casey Hughes Wade from SLK Global Solutions, as well as Paul Gelati, COO of Pinnacle Home Loans, a member of our board of directors and chair of this year's Mortgage Innovators Conference. So great speakers for the MTAM webinar this month. So that will be an event that you won't want to miss. Just a couple of days later, on January 28th, the Mortgage Quality and Compliance Committee will be hosting our first webinar of the year, and we'll be talking about the new QM rule. Our featured speakers will be Joe Liniak, a partner at Dorsey and Whitney, and Angela Cheek, VP and Counsel of Product Compliance at ICE Mortgage Technologies. Very important content, and I know that both the speakers are anxious to share their expertise on the new QM rule. Remember, these webinars are free to anyone in the industry, so we hope that you can join us for MTAM and MQuack later this month. Back to you, Dustin.
All right, thanks, Susan. And now let's get to our conversation. I'm really excited to welcome in Bill Tessar. He's the president of Civic Financial Services, and they're a fairly new member with the California MBA, just joined this past year. And so I'm excited to find out more about them and Bill's journey through the industry. Bill, welcome.
Thank you, Dustin. Happy to be here.
Why don't we start at the beginning? Why don't you tell us a little bit about your background and sort of what led you to Civic and the private lending space? Maybe tell us a little bit more about the company as well.
Yeah, so I started out of college 35 years ago as an originator, Western United States-based company, originated through college, and then for that firm, started a company in the early 90s and built up and have run 3 large mortgage companies over that timeframe. In or around 2017, I sat as an advisory board member with this company, Civic, that was owned and operated by Wedgwood. Wedgwood, incidentally, is the largest fix and flip company in the nation, and they had a private money company. It was 40 employees doing about 20 million a month. And what struck me is it reminded me of what the conventional space was like in the 80s. It was new. It was coming off of the savings and loans and resolution trust corporations and that whole thing. And it's that conventional space has gone a long way and seen an awful lot of change over 3 decades. But I looked at the private money space and said, to me, it felt like it lacked that discipline. It lacked platforms and process and funding sources and technology. And it felt like there was something I could really do with that opportunity. And I kind of felt like I had done most of the stuff I set myself out to do on the conventional side. And so early 2017, I took the role as president and CEO. We had about 40 people, 20 million a month. And over the last 3 years, we're a little north of 300 employees, and we've been funding over $1 billion a year, 18, 19, and even this pandemic, 19, 20. So yeah, it's an institutional private money company. So what that basically means is it's non-owner occupied, really bridge, rehab, fix and flip, multifamily space. And it's very, very different from the conventional space in so many different ways. But it's like starting over, and it's been invigorating and having a lot of fun.
Yeah, well, it sounds like you guys have had a lot of success the last couple of years, so congratulations there.
Thank you.
You kind of mentioned how you guys have done this last year in 2020, but I'm curious, what's your take on that, on the private lending space right now? I mean, considering the pandemic that's still ongoing, lockdown, the economic challenges, everything that all the headwinds there, what's the sort of the state of the market?
Yeah, so leading into COVID, what I would tell you is the space was getting a lot of attention from Wall Street players. And you saw more and more of them, not just bidding on the pools of loans or securitizations, but partnering up, right? You've seen a bunch of acquisitions, Genesis acquired by Goldman, and then Redwood acquired Corvest. And so you started seeing bigger players getting into our space. And I think really it was a chase for yield. Our space provides real yield opportunities that on the conventional side, it's paper thin. An awful lot of volume, paper thin margins, the strong survive, and middle, it's tough to make a buck. So that was going real strong. COVID hits, and literally, Dustin, in a 2-day period. So a loan could be worth a 103, same FICO, same leverage, same borrower. And on Thursday, once this COVID thing got announced, and it really was kind of like that, like, oh, we have a problem, the bid went away. So instead of 103 or 102 or 101 or 100, we had people on Wall Street saying, we don't have a bid. And so what it did was it really exposed the lack of liquidity and financial stability in a lot of the firms in our space, a lot of them. And so you say, well, what does that mean? What happened? I would tell you about 75% of our space stopped lending completely. And why they stopped lending is they had loans on their warehouse line that they couldn't sell. And so they were getting margin called, and some of those people couldn't meet that margin call. And so we had a very strong balance sheet where we have strong financial backing. And so what we did was we tried to find the levels that would at least trade the loans at par. And so during that period of time, 4 months, we had never raised rates in 3 years. We raised rates 5 times in 4 months, and we weren't raising rates for any other reason to find the level on Wall Street that they would at least trade at par. And you can't run a business at par.
No.
So we did that, and we lowered leverages and put guardrails on. And what I would tell you is we picked up some quality individuals who no longer had firms to go to. We felt like we had the right level. We invested more capital in the business to make sure that we could ride this out. And then the market shifted a lot quicker than we thought. And Wall Street solved their problems and they cleared their lines and they started working out workouts for some of the people that were in jams. Some people went away, others emerged slowly. And what I would tell you is, like, now today, like right now in January, it feels like pre-pandemic levels. You got more people bidding on loans. You're driving those premium prices or the pass-throughs down. Securitizations are starting to pop up again. And so to me, it feels a lot like that. As it relates to COVID, I would tell you, like, no one wants to, COVID's bad. People have been sick, people have lost their lives. Economically, it's bad. From a business perspective, the one good thing that happened out of COVID is we proved to ourselves that we can work from home. So we have 85% of our workforce is at home. Deployed computers, deployed printers, because of what you and I are doing right now. So go to Zoom, Microsoft Teams. I actually think it's changed the business world post-COVID. And so we're planning on, like, what does our company look like? We have hundreds of thousands of square feet in commercial space with all of our offices. I don't know that we need all that. And
yeah, so you see that as a long-term permanent change then, at least with your company.
You know, we've seen companies like WeWorks lead us to re-sign up with 75% discount in the first couple months, 50% the next, 25, no negotiating, just like, here's a discount. So you know, like, that's a pretty good indicator that there's some challenges. And what I would tell you is, and I'm probably most surprised by this, not everyone, most people have been happier. They've reconnected with loved ones. They've reconnected with their children. They have to make a living so they can manage themselves at home. But it's been an amazing process for me to watch. I've come to the office every single day.
Oh, really?
I haven't missed a day other than if I was taking that day off every day. And our corporate office is about 40,000 square feet, so it's big. We fit maybe a couple hundred people here. In this side of the wing, there's 11 people.
Wow.
Not a lot. So yeah, to me, I think the aha moment of this whole thing, once we get behind this, is going to be, what do we really look like post-COVID? Are we okay with people working from home? Personally, if it creates a happier version of you, Dustin, and we can support you and you're closer with your family and you're still producing the output, why wouldn't we do that?
Right.
So yeah, so that's really been, we're spending a lot of time right now strategically trying to figure out, if that's part of our business, how do I create your home environment with the best technology? Do we send you guys, lunch in a box? Is there online yoga where we could all stretch at a certain time? Like, what can we do to make that an awesome thing for you? And so we're exploring that right now.
Well, yeah, and I think it's obviously not just you guys. I think a lot of our commercial lending friends on the retail and office side are certainly, concerned about that as well. And so you've kind of hinted at it here, but talk to me a little bit about what sets Civic apart when it comes to culture. As you mentioned earlier on, the private lending space isn't, as traditionally organized and maybe set up as well as the conventional side is. And it's not necessarily a place we think of for a lot of culture-focused companies, but you guys definitely seem to have broken that mold. So what's the secret? How do you guys, how has it helped the business itself?
I coached football for 14 years and I coached baseball for 12. I had two young boys at the time that went through the system, and so I wanted to be closely connected, and I did that. And one of the lessons I learned is that together you can conquer anything. We played much better teams at times, much bigger teams at times, much faster teams at times that played with a bunch of individuals. It's of course at 10, 11, 12, 13, Jimmy wants to hit the home run, doesn't care about laying down a bunt and getting on first and moving the runners. And so early on, I was a team first guy. What I would tell you, what's happened here is, like, I have a belief, if you give more, invest more, do more for people than they deserve, you actually do get back more than you deserve, and you being Civic. So Civic selfishly by investing in Dustin and doing everything for Dustin, friends, family, work, opportunity, career path, even if that meant Dustin shouldn't be here. If you said, hey, I have an opportunity, I'm not the guy that's going to stand in front. I'm going to help you and then keep the doors open if it doesn't work out so you can come back. I mean, it is a chips all in investment in our people. And we do it from snacks to rewards to grand ideas and subjective bonuses. And we do the dry cleaning thing when people were coming to work and all that stuff. And it really is, look, you got to make money. If you don't make money as a company, then you can't invest back in the people. But what I would tell you is we have 14 people in our culture department, 14 full-time employees whose sole responsibility is making sure that our people are good. Sole responsibility, keep, stop, start. Once a quarter, all of our employees tell us what we should keep doing, what we should stop doing, what we should start doing. We take those into consideration. We have grand idea, pay $1,000 a month for the person that comes up with the best idea for the business, cost savings, culture related, income opportunities. So we get amazing amount of input there. And then, you know, we follow the whole scaling up approach. So we pulse every day. First meeting of the day is me and my senior management, and then they go and have theirs. They have theirs. So everyone in the company, 15-minute pulse meeting every single morning. And so if something is affecting Dustin and that manager can't help you, it will work its way up. And if it comes to me, then I'm going to solve it, because that same problem day two is actually a real, like if it was my paycheck was wrong. They missed a $147 expense, and I sent something to HR and they didn't respond. Your manager, if that's bugging you, that it's bugging you, you're thinking about it, so you're not thinking about your job. We need to solve that problem. It's like, it's that sort of thing. And so what I would tell you is, anybody you ask, anybody that is with us or no longer with us, would tell you that unquestionably this is a company that is invested in them. And that's every day. And we have core values and core purpose. Everyone follows that. It's not like a tagline or posters in. We all come from a 4-generation military family, and it was really from the military, but everyone's got a coin. On our coin, it's got our 5 core values: act with honor, be a great partner, communicate clearly, create smiles, simplify, and then our purpose. And so, look, these are guiding lights. You might go, oh, that's cool, it's kind of riddly, I like it. But when you have that fork in the road throughout the day and you have to make a decision, I will promise you, if you follow kind of our core values, you'll figure it out. And if you don't, it's not going to be terminal. It's going to be, corrective, and we'll figure it out next time. And I can't tell you how many times I've been out by myself on a weekend, and I'll pull it out of my, my shorts or whatever. If I see one of our coworkers and they have it, like, our people carry the coin. So there is a little bit of camaraderie and esprit de corps that goes along with that. Again, that teamwork, going back to coaching football and baseball, it's like we're in this together, and it makes a difference. It does. It may sound corny hearing me talk about it, but it's very, very real.
No, not at all. I think if we could just pull this last couple of minutes, I think you've got a great TED talk there on leadership. So, I think everyone listening to this, there's some, clear takeaways with that. That's really fantastic. And as someone who loves team sports myself, that's, you're preaching to the choir here for sure. So let's switch gears here just for a second. Our theme this month obviously is on origination and sales strategies. So from your perspective, what key strategies or tactics are private originators using to boost volume right now?
So I am a little bit different in my approach here. So coming 30 years from conventional, we were never the cheapest price, right? The quick ins or the bigger lenders could always shave price, and banks, could buy the market at any moment. So I really came from the school of thought of, you better bring more value than rate and fee than the next person. It really does have to be about that, like, customer for life approach. And the only way I'm going to do that and not have to worry about rate and fee is to bring something other of value, where if Dustin looked at it, you go, yeah, I would never consider using anyone but Bill Tessar because of what he means to my overall business, not what, yeah, I could get a quarter lower, an eighth lower or save $400. That's not what this is relational. And so, though I didn't need to, I took the same approach that we've taken here. And what I tell our people is two things, and keep it super simple. Focus on building a database. That's hunting, new business. A lot of ways you can do that. Happy to tell you. And nurturing your database. So in the early stages, you do a lot more hunting because you don't have any database. You're in the game early. And that hunting, even old school stuff, like simply getting on the phone, you could pull trust deeds of people that have done private money, get that information, use a reverse directory, get the phone, and call. I mean, there's so many ways that you can reach out, as long as you're not afraid to spend some time on the phone.
Right.
The guys and gals that do it here are the ones that do double-digit volume every single month. And so my thought is do it, and then once you've done that and you've brought the value, make sure you never lose that customer. Because if you, in our business, a good investor, they're going to do 3-4 deals a year, not one deal every 4 years. They're going to do 3-4 deals a year. So why would you ever, with all that energy and effort to find Dustin, let Dustin go work for someone else? Like, nothing should be more important once you got him, to keep him, to check on him, to make sure his project's going well. If it's not, bring some resources, contractors, home design, realtors that will list that maybe at a discount, takeout financing, conventional people. Like, it's your job to solve Dustin's problems, and then he's going to continue to come back to you. At least is the way that I see it. And so our newbies, it's get on the phone and have the output. And then once you get them, we have all kinds of automated ways to keep them.
That's really cool. Yeah, that makes a lot of sense. So, I mean, right now we talked about it a little earlier with the pandemic. So, are there, or what I would say, are the advantages that private lenders have and provide to their borrowers in, I guess you could say, uncertain times like this?
I think the biggest differential on the private money side is that borrowers can go into transactions and act like a cash buyer. We close our deals in 5 to 10 days. We've done 3 days. 3's pushing it a little bit with title and stuff, but 5 to 10 days, under 10, like 95% of the time. So you can actually go and transact, offer, commit, sign agreements to close inside of 10 days, which, being in the space, you can't do it on the conventional side. Right. Forget the refi boom. If the refi boom was behind us, you still can't do it. The very, very best lenders that have it all figured out are 21 days. So, So you're a cash borrower, that's number one. 2, the qualifying, this is really an asset-based loan. So if there's 20% of equity in there, and you're not a knucklehead, you can get financing. You don't, W-2s, tax returns, pay stubs, bank statements, explaining a 1992 Sears late, that's not in our space. So that's part of the speed. So leverage is greater, documentation is less, super fast like cash. And I think as people think about it, even though the rates are higher and the fees are more, and they are, even though that's in play, you'd be surprised. When I first came over here, I thought institutional private money, bottom of the barrel borrowers, these are going to be sub 600. They got a story and scars and they limp into the closing. I was ready for that. Our average borrower is like 718 FICO, net worth significantly higher. These are successful people that don't want to bring the lump of information and deal with the back and forth. They'll pay the rate, they'll pay the fee, they'll get into the transaction, rehab, beautify the home, get out and make their money on the exit. And it's probably my biggest surprise on this space. It's just,
well, it seems like too, I mean, if they're doing, multiple loans and transactions a year, I mean, they want a partner that they can count on, that they know, and it's more than just, someone they're going to forget about and, maybe touch base with in a couple of years. But if they're doing a couple of loans a year, they want someone that they can have an active relationship with, like you guys.
Yeah, I think about like myself. If I were to go to a company like ours, I qualify at any bank or any lender, mortgage banker, broker. I can qualify easy, no problem. But got to bring all my bank statements and my stock, and I got to get W-2s and pay stubs and credit report and all my story, and then I got to wait for them to ask me back and forth. I would pay institutional private money rates and fees if I knew that they can close inside of 10 days and they check the value of the property, I would do it. So if you aren't fast and you do nickel and dime people, then why would they pay? So we've been really good at gut checking ourselves when you start leaning, what, maybe Dustin, we may ask Dustin, well, hold on, back up. We're equity lenders, leave Dustin alone. Like, you have to check yourself because it's easy to fall into conventional thinking as a lender, but this is an equity-based loan. And so you almost have to disqualify yourself as opposed to qualify yourself if the asset is there.
If the equity is there,
That's
yeah,
the way
okay.
Yeah.
That makes sense. So then, I mean, onto that topic there, what is the hottest product right now in the space?
I think bridge loans, number one. So people want to get in and out. They don't have time to close. They have the conventional financing lined up, but for whatever reason, they got to close this deal quickly. That's probably number one. Rehab, number two. What's unique is like a lot of these properties, the dinged up real estate wouldn't qualify conventionally, even if the borrower does. And even if they had time, the property won't qualify. So, we'll go 80% on that and we'll do 100% on the rehab portion. So you could buy a $500,000 home that needs $150,000 worth of work, and we'll give you 80 of the 500 and the full 150, and only charge you the 150 as you draw from that line. So, I mean, where else are you going to get that? And we're going to do that without taking you through the rigmarole of normal conventional financing. So I think that. And then third, I'd say multifamily slowly coming back. I think you're going to see a lot of $1 to $3.5 million opportunities in our space for the multifamily side.
Interesting. All right. So, I mean, we are right in the middle of, a historic refi boom right now that just, certainly kept everyone busy all year last year, and seems like, going forward, at least for the foreseeable future here, we're going to continue to see it. But at some point, it's going to end. So, what impact will that have in your space there? And maybe what are the keys to success looking forward to transitioning away from that business to more of a purchase-focused business, or that's more on the conventional side, but how does it affect you guys?
No, I think Dustin, I think you hit it bullseye. Like because I've been in that space so long, I've seen the cycles, and I've spoken at events and conferences and pods about what will happen on the conventional side, which will then I'll answer what happens on our side. What I believe happens, and I believe it's happening right now, you saw the Treasury earlier in the week, rates went up 50 basis points in a day. What I've told my friends on the conventional side is this: throughout the refi boom was great, unbelievable. Don't leave the purchase business. So the true giants in the space maintain large purchase percentage. Those originators will actually gain market share, because it's my truth that the ones that fish in the refi pond only will make a pivot to the purchase side. Those relationships are secure. They're going to bump up against, they'll do some little price thing and some benefit thing. And then those people will either have to reset the way that they're living because the income is going to be significantly lower, or they'll get out of the space. We saw it the last two refi booms. People came in, people came out. And the financial collapse, they came in, they came out. So I think refis could be down as much as 75%, my personal truth. And if that's the case, then you'll see a lot of originators having to figure things out. What we're hoping is that there'll be more attention, because all of ours has been blocking and tackling one broker or one borrower at a time. Everyone's too busy doing the Smith loan 4 times in a year. We're hoping that they'll open their eyes to a new vein. And I think correspondently, it could end up blowing up that channel for us. We think that the bigger firms are going to need to augment the refi business immediately, and we definitely fit in line with what that would look like. And so we're having those discussions with the bigger firms right now. And look, I think it's happening as you and I are talking. The drop in refis. I keep in contact with originators at the top 10 companies that I've known for years, and they you know what that looks like, right? First it's credit report orders, then it's lower locks, then the lock specials come out because fair market value, you got to get those locks in. So they start sending when you start seeing specials, people at the top are going, we're going to take a hit next month. And And that's literally how it goes. So I've read this chapter of the book a few times, and this is generally how it plays out.
Yes, it's interesting how it impacts you guys in that space. That's interesting.
Rates, right? Rates don't really affect us. It's really finally the people that have been so focused on refis will let us come in and present and go like, you know what? I actually have some borrowers that would fit that kind of channel of financing. So we think we'll get some pickup there.
That's interesting. All right. So like a couple more questions here, a couple more minutes. Let's switch gears a little bit again here. What about so younger originators, younger brokers or correspondents that are entering the business? Why should they give me your pitch on why they should consider the private? I mean, you're kind of doing it now, but why should they consider the private lending space instead of just the more typical route, the more conventional route?
So, I have a deep love for the conventional space. Literally, most of my adult life was spent there, and it's a very crowded space, very competitive space. It's the government's your partner in most aspects of it, and margins for the mothership are razor thin. Like, yes, there were firms that made a mint during this refi boom, but in a normalized market going into the refi boom, there were 8 to 10 companies that would blow you away that were very, very, they were cutting back on the coffee cup orders type of thing, like very close. And so if I were new coming in, I was thinking about one of the two. If I went conventional, I'd make sure I went with a financially sound firm. So that would be number one. But if I were thinking about the other one, we sell 6 loans. Conventionally, we sold 250 different types of loans. So much less to learn early on. The ease of qualification is much easier, which then goes back to the ramp up of the learning curve, learning underwriting guidelines and how to qualify someone and how to talk through sophisticated people like you and I through a transaction when you're fresh out of college. Here it's, get value right, pull a credit report, verify 4 months of reserves, understand what the ask is, and communicate it. I mean, I've oversimplified it, but it is kind of like that. So I think the ramp to like a 6-figure income, if that, let's say someone out of college that was important, is much faster on the business purpose loan side as opposed to the conventional side. And we do a Top Gun program once a year where we had, I think the last one, we had 1,800 applicants. We had, out of the applicants, we interviewed like 140, 150 of them, and we ended up hiring 12, graduating 10, and then like 8 are still with us. But what I would tell you is we've done that we've had 5 programs so far, and some of those originators are our very best because they're not clouded with, oh, let me tell you what it was like during the financial crisis and all that, or I already know it. They just head down and follow instructions. So I think that the path, the barriers to entry are smaller. The path to success is quicker. The amount of information you have to learn is less. And I think that probably makes for an easy transition as a successful originator. To me, it seems like it would be easier to go from the business purpose space to the conventional than the conventional to here, because we had to unlearn stuff. Like everything we learned in conventional, most of that doesn't apply here. Like a lot of the Dodd-Frank stuff doesn't apply.
Yeah.
So you have to unlearn some of that stuff, and there were so many programs. To me, it feels easier to start out in this space.
Interesting. Well, that makes sense. So, all right. Well, final question here, and I mean, I think you're the perfect person to ask this question. Someone who's been, as you mentioned, in both the conventional space and now in the private institutional space, and that's on advocacy. And especially this last year. I mean, you mentioned earlier the margin calls that a lot of the companies had to sort of face down early in the spring or late in the spring last year. So how crucial would you say the advocacy efforts of groups like the California MBA, the MBA are right now? And what would you say to maybe a colleague who didn't quite understand what these groups do as far as advocacy efforts?
Here's what I would tell you, Dustin. Early on when I first started, I looked at it as an expense on your P&L. Didn't really understand the importance of it. I would tell you, if I were advising anyone new. Listen, the seasoned people already know what I'm saying, and they're already nodding their heads, but you have to have organizations like CMBA, MBA. Back in the olden days, it used to be SIMBA. It's the foundation of credibility in our space, and especially in the newer space of private lending, right? And so who is shepherding the cause of all of our critical topics year after year after year? It's not, we're blocking and tackling in our own backyard. So I would almost make it mandatory, like getting a license. You shouldn't be able to have a license and not be part of a group like this and be able to represent yourself in a certain way in the marketplace. It's, to me, if I left this role and went to your guys' role and I was in charge of signing people up.
We're putting you in charge of membership, Bill.
Yeah, I mean, I don't know who said no. Put me through to that person. Let me talk to that person. Tell me about your business model. What keeps you up at night? Wouldn't you want to be part of a group that's in alignment with the way that you're thinking? So for me, it was just the immaturity when I started a business years and years ago in the 80s of, keeping all the expenses out to, like, if I started it today knowing what I know, you would lead with that expense. That's not a necessary evil. It's an absolute mandatory inclusion in a success plan that I just couldn't imagine a company not being part of, like, really. So they're by themselves, basically. Right? So yeah, I think if you want to be top of your game in the industry, you need to be a member, and I think it's a must. And I don't even think that's optional.
Well, you're certainly a team guy, that's for sure. Whether it's coaching baseball and football or here at the industry, so appreciate that. And again, we talked about before we started the conversation here. Obviously, if you look in both our backgrounds, there's some just a little bit of a baseball memorabilia there. And once we get back to in-person events, we'll have to sit down and further the conversation and maybe steer it a bit towards some sports here. But Bill, thanks again for the time. It was great having the conversation with you, and best of luck to you guys in Civic this year.
Appreciate all that you do, Dustin, and looking forward to seeing you in person.
Absolutely, appreciate it. Well, and if you like the conversation, if you enjoyed this back and forth with Bill and I, then make sure and subscribe to us here on our YouTube channel. You can also find us on SoundCloud, Apple Podcasts, and Spotify. And we'll be back again next week for another episode of Connect. We'll see you then.